So you're tasked with evaluating a massive infrastructure project, or maybe you're deciding if a tech startup is worth buying. Or, maybe you're just trying to figure out the true efficiency of your own personal investments.
Hmm.
You always run into this great gatekeeper of finance, the impenetrable wall of acronyms. Everyone wants to know their return, but the language used to calculate it just feels like a secret code sometimes.
It absolutely does. And right at the epicenter of, nearly every single capital allocation decision in the financial world,
Mm.
from the smallest corporate move to the largest private equity fund, you'll find one metric,
Right.
the internal rate of return, or IRR. And the thing is, it is simultaneously the most indispensable number in finance, and you could argue the most dangerous if you misunderstand it.
And that contrast, right, that tension between its power and its flaws,
Hmm.
that is the mission of this deep dive. We are going to extract the essential knowledge you need to be, well, instantly fluent in IRR. What it is, the mechanics of how it's calculated, why giant corporations will literally stake billions on it, and, crucially, its profound limitations.
And our sources for this give us a really comprehensive overview. They blend the dense mathematical underpinnings with real-world case studies and even the long-standing academic debates about where IRR just falls short.
So it's the definitive shortcut to understanding how finance professionals truly measure capital efficiency.
I think so.
Okay, so let's unpack this core definition. At the highest level, the internal rate of return is simply a method, a tool for calculating an investment's expected or actual rate of return.
Exactly. You might hear it called the discounted cash flow rate of return, the DCFROR.
A bit of a mouthful.
Yeah, or sometimes just the yield rate. But that word, internal, it isn't just window dressing. It is the critical defining characteristic of the whole thing.
Okay.
When we call it internal, we mean the calculation is, by its very nature, project-specific. It's isolated from the wider economy. It deliberately abstracts away all those external market factors that affect money.
So things like general inflation.
Inflation, the prevailing risk-free rate you could get on government bonds, the firm's own cost of capital, any specific market volatility, all of that is intentionally stripped out.
So it's a pure measure of the project's own profitability then, without any reference to the context it's operating in.
Precisely. It isolates the rate of return generated purely by that project's specific sequence of cash inflows and outflows. And that isolation is what makes it so useful for comparison.
Also.
Well, you can compare a factory in Brazil to a software license deal in Germany because the IRR is stripped of all that regional economic noise.
And because it's a calculation that only depends on the project's cash flow stream, you can use it both ways, right? Looking forward and looking back.
That's right. We use it ex ante when we're evaluating a proposal. We estimate the future cash flows. We calculate the resulting IRR, and that helps us decide whether to even launch the project. That's its big role in capital budgeting.
And then, years down the line, you can apply it ex post.
Exactly. You take the actual historical cash flows and you measure the exact achieved return of that investment. It produces a single annualized compounded number that's designed to answer one question. What annual rate did this venture actually produce for the capital we invested?
Now that we have that intuitive definition, let's dig into the technical core. Because I think understanding the math behind IRR is probably the only way to truly grasp why it generates some of those dangerous pitfalls we're going to cover later.
Right. And the technical definition connects IRR directly to the other giant of finance, net present value, or NPV. The IRR of an investment is formally defined as the annualized effective compounded return rate.
Okay.
That sets the net present value of all cash flows, both the positive ones and the negative ones, from that investment equal to zero.
That sounds dense, but it's the pivot point. We're not just looking at total cash received versus total cash paid out. We're bringing everything back to today's dollars, and then we're finding the one single interest rate that makes the whole thing just balance out.
Absolutely. Think of it this way. IRR is the interest rate at which the present value of all the future cash flows you receive is exactly mathematically equal to the present value of all the cash flows you paid out.
Which is usually that initial investment.
Usually. And if those two present values perfectly cancel each other out, the total net present value is zero.
So it really acts like a break-even metric. And that break-even rate is what links it so closely to NPV for any single project.
That's a crucial insight. The IRR signifies the required rate of return that makes the project only marginally justified. If your cost of accessing capital is exactly equal to the IRR, you break even in present value terms. You haven't destroyed any value, but you haven't created any extra wealth either.
And this is where that classic investment decision rule comes from, isn't it? It relies on comparing the IRR to your minimum acceptable rate of return, your hurdle rate.
Exactly. If you calculate a positive NPV using your firm's cost of capital as the discount rate, it means the project is expected to generate value above that hurdle rate. That justifies the investment.
So if the IRR is higher than the hurdle rate, then, mathematically that the NPV has to be positive. The project is adding value.
Correct.
But wait a minute. If NPV tells us the actual dollar value created, and that's the ultimate goal, right, maximizing shareholder wealth, why don't we just rely on NTV? Why do we even need IRR, this, break-even rate?
That's a great question. It's because the IRR inherently accounts for the time preference of money in a way that a simple percentage just can't. And it allows for a rate-based comparison of capital efficiency.
Time preference. The idea that $1 today is better than $1 tomorrow.
Right. Because money you receive today can be invested immediately and start compounding. That's why we have to discount future cash flows in the first place.
So an investment that returns money to you quickly is fundamentally more valuable than one that holds onto the money until the very end, even if the total dollar profit is identical.
That's right. And the IRR calculation quantifies that time value. Let's say Project A and Project B both promise a total profit of $10,000. But Project A delivers $8,000 of that in year 1, while Project B delivers the whole $10,000 in year 10.
Project A is going to have a much higher IRR.
Significantly higher. The discount factor that you apply to that money in year 1 is much smaller than the heavy discount you have to apply to the money you receive 10 years from now. It makes the present value of that early money much, much greater.
It's a bit like duration in the bond world. Fixed income assets, like bonds. A bond with a high coupon rate is paying out cash earlier, so it has a shorter duration.
That's a good way to think about it. Imagine a simple zero-coupon bond. You buy it for, say, $800 today, and it pays you $1,000 in 5 years. Its IRR is fixed based on that one single cash flow in the future.
Okay.
Now, compare that to a coupon bond. You buy it for $1,000, and it pays you these little bits of interest every 6 months until it matures.
The IRR on that coupon bond is going to be way more sensitive to the timing of all those little payments.
It is. The IRR effectively measures the average time it takes for you to recover your invested capital, weighted by the yield. The earlier the cash flows, the shorter the duration, and generally the more effective the rate of return. This time sensitivity is really the engine that IRR uses to measure capital efficiency.
We've established the foundation, but where does this actually show up on a corporate balance sheet? Let's talk about how corporations use this, starting with that really crucial distinction between IRR and NPV that our source material highlights.
This is where we have to draw a hard line. As financial metrics, they really do serve different masters. IRR is fundamentally an indicator of profitability or efficiency or yield. It's a rate. It's a percentage.
Right.
It tells management how effectively they are deploying capital relative to the size of that investment.
In contrast, NPV is the measure of magnitude, the actual dollar amount of net value the project is projected to add to the firm's total wealth.
And that's the tension. A 40% IRR on a small pilot project might make your internal management team look great, but it's adding negligible value compared to a 15% IRR project that requires $1 billion investment and adds $100 million in NPV.
And that tension is what defines corporate capital budgeting. So corporations use IRR as this initial filter in a process where they're deciding which projects to greenlight. The basic rule is, if project IRR is greater than the cost of capital, the project passes the screen.
Correct.
But how do they even figure out that cost of capital? That sounds like a really complex number on its own.
It is. The minimum acceptable rate of return, that hurdle rate, is usually tied directly to the weighted average cost of capital, or WACC.
WACC?
Yeah, WACC is the average rate the company pays to finance its assets. It considers the cost of its debt, so interest payments, and the cost of its equity, which is shareholder expectations. But that number is often adjusted upward based on the specific risk profile of the project.
So a high-risk R&D project is going to have a much higher IRR hurdle than, say, a stable, predictable upgrade to existing infrastructure.
Oh, absolutely. Much higher.
So if they're comparing, let's say, building a new regional distribution center versus buying a fleet of autonomous delivery trucks, they calculate the IRR for both and assuming they both pass that hurdle rate.
Exactly. And the project with the higher IRR is generally considered superior, provided the company's capital budget is limited, and the goal is to maximize the rate of return on invested capital.
And that's a common situation, right? Even for cash-rich companies.
Yeah.
Because management and just organizational capacity is always finite. They can't do everything.
Always.
That context of limited resources, that brings us to one of the most important practical differentiations in these large-scale projects.
Yeah.
Project IRR versus equity IRR.
This is a massive distinction, especially in private infrastructure deals, real estate, and leveraged buyouts. The project IRR measures the return of the overall asset itself.
Unlevered.
Yes, it's the unleveraged return. It calculates the return assuming the cash flows directly benefit the project, regardless of how that project was financed.
And the equity IRR is the shareholder's return, the view from the investor who actually put in the equity capital.
Precisely. Equity IRR considers the returns for the shareholders after all the project's debt obligations, the interest payments, principal repayments, all of that have been serviced.
I see.
And if a project is highly leveraged, meaning it's financed with a large amount of relatively cheap debt, that leverage can really turbocharge the equity IRR. A project IRR of, say, 12% could easily translate into an equity IRR of 25 or even 30%.
And that's why investors often chase those highly leveraged deals.
It is, and it makes that equity IRR figure crucial for reporting back to investors, particularly in private funds. It's what the limited partners, the actual investors, see, and it reflects the success of the financial structuring just as much as the success of the underlying asset.
So it's absolutely vital to know which figure is being quoted. A high project IRR indicates a fundamentally sound asset, whereas a high equity IRR might just indicate aggressive but successful leverage.
You have to ask the question.
And IRR's application broadens far beyond just corporate finance. I mean, it is everywhere. Let's look at its usage in fixed income.
In the fixed income world, IRR is formalized into metrics like yield to maturity or YTM. The YTM calculation is structurally identical to IRR. It's the single discount rate that makes the present value of all the bond's future cash flows, the coupons and the principal repayment, equal to the current market price of the bond.
That's a perfect example of IRR being used to solve for the market implied rate rather than a prospective project rate.
And in the world of savings and loans, when banks talk about the true cost of borrowing or the true return on a deposit account, they often use the effective interest rate, and that rate is simply the IRR of the cash flow stream you're committing to, factoring in how often it compounds.
We also noted that IRR can apply to liabilities. If you structure some complex financing package, the IRR of that liability stream is the true cost to the company.
Yes, and the evaluation rule just flips. For an asset, a higher IRR is better because you want a higher return. For liability, a lower IRR is vastly preferable.
Of course.
A complex loan with an IRR of 7% is economically superior to one with an IRR of 9%, because that 9% rate means the compounded cost of that liability is much, much higher over time.
This cost evaluation also plays a key role in a corporation's capital management strategy, particularly when it comes to stock buybacks.
Share buybacks are, at the end of the day, an allocation of capital. When a corporation uses its cash to repurchase its own shares, it's essentially investing in itself. It reduces the share count, potentially boosts earnings per share, but they have to evaluate this project using IRR.
So they're asking, does repurchasing our shares deliver a higher IRR than building that new factory or acquiring a smaller competitor?
Precisely. If the IRR of returning capital to shareholders through a buyback, and that's calculated based on the cash spent and the expected appreciation of the stock price, is higher than the IRR of their other available investment candidates, the buyback proceeds.
It's a constant internal competition for the company's limited financial resources.
And IRR is the scorecard they use to compare these fundamentally different types of opportunities.
And then there's a segment where IRR holds this almost sacred status, private equity, though, as we're going to see, that status is increasingly fraught with issues.
Private equity funds rely on IRR to measure the general partner's success. That's the fund manager. For the limited partners, the LPs, the IRR calculation is how they gauge the manager's ability to efficiently deploy capital, control the timing of cash flows, and generate a superior rate of return on the capital they committed.
The timing is key there.
The timing of investments and distributions, the J-curve effect, makes IRR particularly sensitive in that environment.
Okay, we mentioned earlier that the math behind IRR is what gives it both its power and its complexity. Let's try to make that accessible. At the heart of it, it's a quest for that single discount rate, we'll call it 2, which makes the net present value exactly 0.
Correct. We're trying to solve a specialized algebraic equation. The formula for NPV requires summing up all the cash flows, let's call them 6 nulls, and discounting each one by 1 plus $2 raised to the power of the period none dollars. And that entire sum has to equal 0.
That initial investment, $2, is usually your big negative number sitting right at time 0.
Right. And the presence of that discount factor, that $1 plus R day, where $2 is the unknown rate we're trying to find and then goes up to 5, 10, maybe 20 years, that creates the mathematical challenge. When n gets large, this equation becomes a complex, rational polynomial equation.
And what does rational polynomial mean in practical terms for an analyst?
It means you can't just use algebra to rearrange the equation and isolate per dollars. It's not that simple. If none dollars is greater than 4, there is generally no closed-form analytical solution.
So you can't solve it directly in a few clean steps.
No. This is why analysts don't use calculators. They use computers and iterative algorithms.
You need a computer to basically start guessing and then refining that guess.
Exactly. Tools like Microsoft Excel or, specialized financial modeling software, they use built-in functions like IRR or XIRR. And these employ sophisticated methods to iteratively home in on the exact rate that balances the equation.
Let's make this tangible with that specific cash flow sequence from our sources. It's a nice, clean example, just over 3 years.
Okay, let's imagine this venture. At year 0, the initial outflow, CC dollars, is negative $123,400. That's our investment.
Right.
Then we have positive inflows over the next 3 years. $36,200 in year 1, $54,800 in year 2, and $48,100 in year 3.
Now, if you just add up the inflows and subtract the outflow, you get a total profit of $15,700. But that tells us nothing about the efficiency or the compounded rate of return.
We need to find tour dollars, so let's just guess that 20%. We plug it in. We discount those 3 cash flows at 10%, and we find that their present value sums to about $116,920.
Which is less than our initial investment of $123,400. So our MPV is negative. Our guess was too high.
Way too high. So we need to try a lower rate to increase the present value of those future dollars.
Okay, iterate down.
We iterate down. If we try 4%, the present value of the inflows is $125,500, which is now too high. That gives us a positive NPV. So by running the algorithm between 4 and 10%, the computer finds the precise balance point.
And the answer is?
The internal rate of return is 5.96%. At that specific rate, the present value of the inflows equals $123,400, and the NPV is 0.
This necessity for iterative calculation brings us to the actual methods used. You mentioned the second method earlier. Why is that often preferred for solving these types of equations?
Well, the second method is highly efficient for these kinds of functions. It uses successive approximations. It takes 2 initial guesses, calculates the NPVs for both, and then it draws a straight line, a second line between those 2 points.
That's it.
It then predicts where that line would cross the 0 NPV axis to provide a third, much better guess. It just repeats this process very, very quickly until the solution converges to the accuracy you need.
That iterative process is why it's so powerful, but also why that one unique case, a single initial outflow followed by all inflows, is so clean mathematically.
Right. When you have that very common profile $6 is negative, and then all the other dollars are positive, the NPV function is mathematically well-behaved. It's convex and strictly decreasing as the interest rate increases.
Okay.
And this beautiful mathematical property guarantees that there is always one and only one unique, real solution for the IRR. This is the ideal scenario.
But the real world, as you noted, rarely involves cash flows happening on these neat, tidy annual dates. And that's where the XIRR concept, or the extended internal rate of return, comes in.
XIRR is the necessary adjustment for real-world finance. When cash flows occur on irregular dates, say a deposit in March 2024, another in October 2025, a withdrawal in January 2026, the period dollars in our formula has to be replaced by 20.
What's the dollar?
$2 is the exact time difference in years between the starting date and the date of that specific cash flow.
So $2 isn't a simple integer anymore. It's a fractional number. And the exponent of $2 is now a decimal.
Correct. The formula adjusts to reflect that. And because the exponent is fractional, the equation becomes significantly more complex to solve numerically. You often need more robust methods like Newton's method. The point is, finding this seemingly simple rate requires a lot of computational power to manage the time weighting accurately.
This complexity means that when the math gets even slightly messy, the IRR can quickly break down or give you really misleading answers. We need to spend significant time on the limitations, because this is where the difference between a great financier and a mediocre one really lies. Let's start with the central conflict: IRR versus NPV in decision-making.
This is the eternal dilemma in capital budgeting. For one standalone project, they're equivalent. An IRR above the cost of capital means a positive NPV. Simple. But when you're choosing between mutually exclusive projects, you can build factory A or factory B, but not both, they often give conflicting advice.
Because one maximizes the rate and the other maximizes the total value.
Exactly.
We know that maximizing total net dollar value, the NPV, is the theoretical goal of the firm. It maximizes shareholder wealth. So why does management still so often favor the IRR, the rate?
It comes down to performance measurement and organizational behavior. Sometimes it's called the agency problem. Managers often have their bonuses or performance reviews tied to achieving certain rates of return on invested capital. IRR is a measure of capital efficiency and scale-independent profitability.
So it's easier to communicate.
It's easier for a manager to defend a 35% IRR on a small project than to defend a 12% IRR on a huge complex project, even if the latter generates far more overall NPV. IRR provides a clean, comparative percentage that's easily communicated and celebrated internally.
So we have this conflict driven by the objective. Let's dive back into that detailed max value versus max return scenario. This really highlights the economic chaos that can result from prioritizing the rate over the dollar value.
Okay, so the setup is clear. A $100,000 budget limit and a 10% cost of capital.
Max value wants the largest net worth increase. Max return wants the highest rate achieved on any capital deployed.
And we have project one, big is best. You invest the full $100,000, you get $132,000 back in 1 year. That's a 32% IRR. And crucially, the NPV, discounted at 10%, is a massive $20,000.
Then we have project two, small is beautiful. You invest just $10,000, you get $13,750 back in 1 year. Its IRR is a whopping 37.5%.
Right.
But its NPV is only $2,500.
So max value chooses big is best immediately. She captures $20,000 of NPV, she exhausts her budget, and she maximizes her wealth increase. It's a simple decision for her.
But max return, he chooses small is beautiful, locking in that glorious 37.5% rate. But now he has $90,000 of idle cash remaining, which he has to hold or invest somewhere else.
And this is where the whole debate lives. Max return's decision is only rational if he is absolutely certain he can find other high-rate projects, say a 40% IRR project, for that remaining $90,000 before max value can reinvest her profit.
And if he can't?
If he can't, and that $90,000 is simply invested at the 10% cost of capital, his total combined NPV will be lower than max value's $20,000. He sacrificed guaranteed total wealth today for the hope of higher rates tomorrow.
That is a profound conceptual point. IRR implicitly assumes you have the opportunity to reinvest the remaining capital at a sufficiently high rate to compensate for foregoing the larger NPV project. If your future opportunities are only marginally better than your cost of capital, you made the wrong decision.
And that leads to another structural limitation people often overlook. IRR really shouldn't be used to compare projects of vastly different scales or durations. A low IRR, long-duration project might deliver massive NPV simply because the cash flows run for 40 years.
While a high IRR, short-duration project maximizes the rate but adds very little net dollar value to the firm.
Exactly. IRR obscures the sheer volume of cash involved.
The second massive mathematical hurdle is the multiple IRR problem, which is just a mathematical nightmare caused by non-standard cash flows.
This happens when the cash flow stream changes sign more than once. The standard project is negative, your initial investment, then positive all the profits. The trouble starts when the pattern is negative, then positive, then negative again.
Can you give us a real-world scenario for that, where a project starts requiring cash, generates profit, and then suddenly requires a huge cash outflow years later?
Oh, the classic examples are environmental liabilities or regulatory requirements. Think strip mines, chemical processing plants, nuclear power facilities. You invest heavily today. That's your first negative. You run the facility for decades, generating massive positive cash flow. But then 25 years later, you are legally mandated to decommission the site, clean up toxic residue, or dismantle the reactor, resulting in an enormous negative cash flow in the final years.
So this pattern negative, positive, negative creates the mathematical possibility of two, or sometimes even more, real IRRs. Why does that happen?
It's because the cash flows are being viewed from two competing perspectives across the timeline. In the initial phase, a high discount rate is great because it means your return is high. But when you hit that final large negative cash flow, the liability, a high discount rate, is suddenly terrible because you don't want your cost to compound quickly.
So low rate is good for costs.
A low rate is good for costs. So the equation, which is trying to find a single rate that works for both the profit phase and the cost phase, can find two rates that balance everything out to zero.
That's incredible.
It is. Our source gives the example of cash flows of -10, then +21, then -11. And for that stream, both 0% and 10% are mathematically correct IRRs. An analyst could choose either one to present.
So if management prefers high rates, they might just choose the 10%, even if 0 is also valid.
It creates ambiguity, and that ambiguity renders the IRR metric essentially meaningless for decision-making purposes in these complex projects.
So the knowledge to extract here, based on Descartes' rule of signs, is that the number of real IRRs you can potentially find is constrained by the number of times the sign of the cash flow stream changes. If it changes twice, you can have up to 2 real IRRs. That's the danger zone.
Absolutely. And this mathematical instability is why, for complex projects like energy infrastructure or mining, analysts have to rely on alternatives like MIRR, which we'll discuss in a bit, to impose economic reality back onto the equation.
Okay, now, let's move to the most controversial aspect of IRR, one that has been debated in finance textbooks for half a century, the reinvestment debate. Does IRR assume that interim cash flows are reinvested at the IRR itself?
This is an incredibly sticky point, largely because the language used in textbooks is, well, often an oversimplification. There are two strong camps. Camp A says, yes, implicitly, the calculation assumes any intermediate profits generated are reinvested at the calculated IRR until the end of the project.
And Camp B?
Camp B says, absolutely not. The calculation makes no economic assumptions about future reinvestment. It merely calculates the rate of the original cash flow series.
The nuance is subtle, but it's crucial. Let's use that 3-year bond example from the source material to cut through the confusion. It supports the argument that the IRR calculation is fundamentally neutral to reinvestment.
Okay. The setup is a $1,000 face value, 3-year bond with a 5% coupon. The bond's IRR, its yield, is exactly 5%.
Scenario A. The investor gets the $50 coupon payments every year and just spends them. Or, puts them in a shoebox. Total cash received is $150 in coupons plus the $1,000 principal at the end.
Right. Scenario B. The investor immediately reinvests those $50 coupons back into the project or a similar 5% vehicle. By year 3, those compounded coupons total $157 and change. The total dollar return is higher.
But, and this is the key part, when you run the IRR calculation on both sets of cash flows, the set where coupons were spent and the set where the larger final amount was received, the calculated IRR remains 5% in both cases.
The reason is that IRR is an equilibrium rate. In scenario A, you discount the early coupons back at 5%. In scenario B, you receive a larger lump sum later, but you apply the same heavy 5% discount over 3 years. The present value of both streams at 5% equals the initial $1,000 investment.
So the calculation itself doesn't require a reinvestment assumption. It just finds the rate that makes the present value of the stream equal to the outflow, regardless of what the investor does with the money in the middle.
That's the most accurate way to frame it. The IRR is a mathematical construct reflecting the rate inherent in the timeline of the payments. The economic feasibility of replicating that rate by reinvesting the interim cash flows is a separate real-world concern.
And our final major limitation focuses on private equity, where IRR figures can be highly misleading because of strategic timing. The critique by the academic Ludovic Phalippot is particularly potent here.
Phalippot argues that private equity IRR is inherently gameable. Because IRR is so heavily weighted toward early cash flows, fund managers, the general partners, can significantly inflate the headline IRR figure by achieving early successes and ensuring a quick distribution of those profits back to investors.
Right, if a fund has a quick, successful exit in year 2, that early positive cash flow dramatically increases the IRR because it's barely discounted at all.
Exactly. That early win can make the entire fund since inception IRR artificially sticky and high, even if the remaining 80% of the portfolio underperforms over the next 8 years.
Wow.
Filecto points out that LPs, the investors, often get distracted by these inflated IRR figures, which often aren't even comparable across funds or to public stock market indices.
So the recommendation is to focus less on the rate, the IRR, and more on the money-on-money multiple, the MOM, which is just how many dollars were returned for every dollar invested. That seems much harder to manipulate with timing.
Mom, while it ignores the time value of money, gives you that necessary perspective on magnitude and total wealth creation. It forces the LP to step back from the game of timing that a high IRR encourages.
Given these profound flaws, the conflict with NPV, the multiple solution problem, the potential for gaming, it's no surprise that finance professionals developed alternatives designed specifically to stabilize the rate calculation. And the most well-known fix is the modified internal rate of return, or MIRR.
MIRR was created to address the two main conceptual flaws of traditional IRR: that mathematical instability that creates multiple solutions, and the ambiguity around the reinvestment rate. And it does this by abandoning the internal nature of the metric.
By abandoning the internal nature, MIRR forces the analyst to explicitly state the external rates that govern the project.
It uses two crucial external rates. First, it uses the company's cost of capital as the discount rate for all the outflows, all the costs. Second, and most importantly, it assumes that all positive interim cash flows, the benefits, can only be reinvested at a realistic external reinvestment rate.
Which is often the cost of capital again, or some predetermined safe rate.
Exactly. So MIRR essentially consolidates all future cash inflows to the project's end date, compounding them forward at that external reinvestment rate, and then it discounts that single terminal value back to the present using the cost of capital.
That transformation achieves three vital things. It anchors the project's performance to the real economic conditions of the firm's financing. It gives a better idea of the return the firm will actually realize.
And most importantly, because it transforms the complicated cash flow stream into a single initial outflow followed by a single final inflow, it mathematically guarantees a unique single solution. It solves the multiple IRR problem.
That makes MIRR a far more robust decision-making tool, though the original IRR still seems to reign supreme in terms of just popularity and historical usage.
It does, but academics continue to push for improvement. Our sources mention even newer, more rigorous approaches designed to solve the 18 specific flaws noted in traditional IRR, like the average internal rate of return, or ARR.
The ARR approach, introduced by Magny in the early 2010s, tries to ground the concept in the intuitive notion of the mean, or an average.
Yes. Instead of relying on that complex discounting formula, ARR focuses on calculating a rate that represents the time-weighted average rate of return realized over the investment's life. It makes it behave much more like an annualized average interest rate. It's highly complex to calculate, but its development really shows the continuing struggle to create a single, perfect metric for capital efficiency.
Finally, let's look at how IRR translates to your personal finances. This is where it becomes a money-weighted performance measure for investments, like your brokerage account.
When you look at your investment performance, you typically see two measures: time-weighted return, TWR, and money-weighted return, MWR. TWR is what mutual funds and index funds use. It removes the effect of your deposits and withdrawals to just measure the performance of the manager.
Okay.
MWR, which is exactly where IRR is used, measures your personal performance.
So the IRR of my personal portfolio is essentially asking, what annual interest rate would an idealized fixed-rate savings account need to have in order to achieve the exact same ending balance, given the exact size and timing of all the deposits and withdrawals I made?
It's highly personalized and extremely sensitive to timing. If you're diligent and you invest a large sum right before a major market rally, your MWR, your IRR, will look spectacular.
And conversely, if you dump cash into the market right before a crash, your MWR will suffer disproportionately, even if the underlying asset class eventually recovers. It's a measure of investor behavior as much as asset return.
That's a perfect way to put it.
But even here, that multiple IRR problem can show up if you use the traditional calculation on a portfolio that goes negative, say, if you borrow on margin.
This is a classic dilemma. Mathematically, the traditional IRR calculation assumes that the interest rate you earn on positive balances is identical to the cost of capital charged on negative balances, which is, of course, not true.
Not true at all. In the real world, if you borrow on margin, the brokerage charges you a much higher external rate for that debt.
And that economic reality is what necessitated the fixed rate equivalent, or FREQ, solution.
FRQ.
FREQ is a calculation tailored for personal finance that solves that multiple solutions issue. It introduces a realistic externally supplied cost of borrowing the actual margin rate for any negative balances. It brings the theoretical return much closer to the economic reality the investor is actually facing.
So what does this all mean for you, the listener? The internal rate of return is undeniably a foundational concept. It's the lingua franca of finance when you're discussing efficiency and yield, but it has to be viewed as an incomplete picture.
That is the ultimate synthesis. IRR is a magnificent tool for measuring the rate of return inherent in a sequence of cash flows, but its internal nature is its greatest weakness. You must never rely on it in isolation, especially when you are comparing two projects of vastly different scale, or those with non-standard cash flow patterns that might risk the mathematical chaos of multiple solutions.
Because if you rely purely on IRR to rank projects, you risk making the max return mistake. You maximize your percentage rate of return while sacrificing millions in total net dollar value created for the firm.
It's the constant tension between rate and scale. Max Return, having chosen the highest IRR project for $10,000, was left with $90,000 sitting idle. And so here's our final provocative thought for you to mull over. If you were Max Return and maximizing your rate was everything, what level of confidence would you have to hold that a new, better than 37.5% IRR project would appear tomorrow before you would choose the guaranteed $20,000 NPV project today?
The difficulty of answering that question shows why IRR, despite its usefulness, can never fully replace the goal of maximizing total value.
And for those of you eager to see how modern financial theory tries to resolve this conundrum, exploring the average internal rate of return, the IRR, and its approach to capital efficiency is certainly the next logical step.